Hello and welcome to another episode of Global Business Insights, where we bring fresh thinking by seasoned professionals on the main business headlines. Today our focus is on oil markets in 2025. Tesla shares were up on more Trump trade. This time the speculation followed a report that Trump's transition team want to introduce new regulations for self-driving vehicles. Tesla up over 7% in Wall Street. European Central Bank policymaker and Bundesbank President Joachim Nagel has said that Trump's tariffs may have just a minor impact on inflation. He also added that global integration would have to decrease substantially to cause a noticeable rise in inflationary pressures. Markets are relatively calm, with no high impact macroeconomic data releases today, and focus on the geopolitics and comments from central bank officials. We replay our chat with special guest Soji Elias, an expert in global markets and chief counsel at Greyhorse Financial Corporation. He comments on how more African economies can take advantage of global finance opportunities. Looking at crude oil, Brent crude is up 2.56%, close to $73 per barrel, as fighting between Russia and Ukraine intensified over the weekend. Any uptick was still offset by concerns about fuel demand in China and forecasts of a global oil surplus weighing on markets. The International Energy Agency said just last week that global oil supply will exceed demand in 2025, even if OPEC Plus cuts remain in place, as rising production from the United States and other outside producers outpace the sluggish demand. An excess supply of over 1 million barrels per day, that's over 1% of world output, is a headwind for OPEC plans to resume raising outputs. To be clear, there are three forces that are impacting 2025 oil dynamics. First is the unresolved 2025 surplus amid tepid demand scenarios. Second is the unpredictable Middle East geopolitics. And third is the agenda of the incoming Trump administration that has recently appointed Chris Wright, the CEO and founder of Denver, Colorado-based Liberty Energy, one of the pioneers who helped launch the American shale revolution that fueled American energy independence. According to a recent Morgan Stanley study this year, oil has been broadly balanced as demand absorbs more disciplined OPEC output growth. OPEC spare capacity at high level is also sufficient to prevent a large geopolitical risk premium, but spare capacity is also concentrated in few countries. OPEC may indeed be less prepared for additional supply gluts from a spike in U.S. production. For 2025, demand will depend on what happens in China, India and the rest of Asia, with growth put at just over 1 million barrels per day and close to the historical trend. That's demand growth. Notably, China's oil demand has fallen year on year in the last few months. Perhaps that is another red flag. Also on investment, deep cuts to capex, as we saw in 2020-2021, are slowly recovering, but non-OPEC supply has been flat, mostly less than expected. The largest non-OPEC player, the United States, saw 295,000 barrels per day year-to-date drop in October from the previous year, with drilling in the Permian and frac operations apparently stabilized. But that could change dramatically. The average break-even price in U.S. shale is still a low $53 a barrel. The incoming administration will do all it can by reducing regulation and easing cost of doing business to incentivize more activity. We could see the cost drop to under $50 for the cheaper basins over the next 2 years. It may be, however, more realistic to expect that crude at under $60 is unlikely to be attractive enough for investors. Also, most new exploration with new land exploration permits may take at least 2 years to come to production, and so most analysts do not see a significant spike in US production in 2025. Morgan Stanley, before the US elections, had predicted a 1.3 million barrels per day surplus in 2025. This can only go higher, but by how much depends on execution of new US energy policy. On oil prices, there has been a strong co-movement with interest rates and also correlation with the cyclicals defensives ratio within the S&P index. Prices, that's oil prices, tend to go down as cyclical stocks drop expectedly. That's a read on the mood of the economy. In the downstream, margins are under pressure, and latest estimates of global refinery runs are lower than in May by about 1 million barrels per day, even as refining capacity picks up cautiously. Of late, we've seen more closures and contraction in refining than in the last 3 years. Prices of petrol gasoline are also trending down. In the long term, Morgan Stanley still sees a slowly shrinking share of fossil fuels, more than offset by the total market growth and well over 100 million barrels per day of demand by 2030. In short, the elephant in the room could still be the Middle East geopolitics, which many seem to have priced in already, but also the absence of a more direct fiscal stimulus out of China is casting a shadow on oil demand outlook. And then, of course, higher US oil production with the Trump presidency and looming OPEC Plus plans for an output raise. A lot to chew. OPEC members, of course, are under fiscal stress. Let's just say in 2025, be prepared for much lower prices than what most are accustomed to. Still on tax reform in Nigeria, it was reported that as uncertainty beclouds the fate of the proposed tax reform bills in the National Assembly, the committee is proposing a 50 million naira tax exemption for small and micro businesses in the country. From my limited experience in managing change when dealing with policy reform that involves many sensitive change themes, workshops and sessions are great, but most people conceal their concerns in the open fora. The change leader needs to ferret out, mostly informally, where differences and disagreements exist. He needs to understand the power maps, that is, who influences key stakeholders and what issue, and understand how best to reach and inform and how best to change the mind of the main influencers. This can be a long, painstaking process and sometimes requires time to succeed. Many believing putting people in a workshop when someone extols the value of an idea means you are carrying them along, but sometimes the choice of who and how to carry the message is more important than the content. Reform is too important for us to miss it, and sometimes a communication approach that works well in a different context will not work in Nigeria. I do sincerely hope reform champions attend to these more subtle change matters. Beyond possibilities in working closer with fast-growing emerging economies like India, Africa and developing economies can do more to improve integration in global markets. Of late, more interest in Euro bonds have been seen as developed economies normalize rates and yields from emerging markets and African Euro bonds, all these becoming much more compelling. Soji Elias is an expert on global markets and chief counsel at Greyhorse Financial Corp, and he comments on how African economies can take advantage of global finance opportunities.
They've pretty much always been there. At least it often looks that way, and they always will. They serve the interests of the willing and able, and in particular the ready. They are currently all about democratized access, transparency, and so forth, so that it is certainly, without any doubt, a matter for market entrants, market operators to ready themselves, as nobody else will do that for them, save and except the markets themselves, in accordance with how they are structured. Now, with reference to the vast majority of African markets, and all the deficits and challenges of market depth and so forth, market sophistication and so forth, that can make them relevant, or perhaps more relevant than they may or may not currently be. It is certainly the case that these markets have been described as emerging or pre-emerging markets for quite some time. Not many are up to the grade of emerging markets yet. There are all sorts of reasons, some might say good reasons even, for that scenario, but the markets wait for no one. We need to stop wondering how it is that global markets are relevant to local economies in Africa, because they are. They are part of a juggernaut. They need not necessarily be the ghetto of the global financial system, such as they may be at this time. Participation tends to hinge on matters like diaspora remittances and things of that nature, financial inclusion and so forth. The scope can be ampler. For example, fabled Nigerian Eurobonds are a particularly attractive instrument in those markets. And they certainly could enable the aforesaid pair of points that tend to characterize the participation of Africa's economies. But the message I want to pass on is actually a much narrower one, albeit one that has significant import. And the message is perhaps not that far removed from the standing message for structural adjustment from the International Monetary Fund from time to time. As I say, it is about the readiness of these economies and the responsibility taken by the economies themselves or their operators to ensure that readiness. Invariably, it is a matter of policy, a matter of economic preparedness, a matter of economic planning, strategy, and so forth, which is to say that it's a matter of expenditure. These economies have to ready themselves on a longer term footing for their plug-ins to the global financial markets. This will involve policy and its execution. It will involve education. It will involve reinforcing the infrastructures required to enable access to these markets. Now, those infrastructures include matters which will make each of these markets a lot more transparent. These are algorithm-led markets, these global financial markets, which means that the local markets must be able to proffer reliable data for the digest and result of those global financial markets. However far from the providing economies those global financial markets may be. Now, governments need to apply their best resources, the best efforts to enablement of their local economies, such that within specified timeframes, local economies receive the attention that they must have, with a view to positioning them for the advantages of global finance. Those advantages continue to proliferate and to multiply based on the tastes, based on the preferences, based on the attractions that are self-evident to these self-driven global financial markets. Local regulations have to be robust and they have to be good for export. The responsibility can't be placed anywhere else but firmly on the shoulders of market makers at local levels.
European markets mostly lower, with investors focused on geopolitics and regional inflation data. US markets are mixed, seeking new direction from Nvidia, earnings due this week after a report highlighted overheating issues with its latest Blackwell AI servers. Well, that's all we have on this episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing on Facebook, LinkedIn, X, and YouTube. And again, thank you so very much for watching. Bye-bye.